Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the Stockstowatch and the stock market news you need to see. And Nation, the Magnificent 7 stocks fell hard throughout the earnings season, with the group down 15% just since their July peak, pretty much flat since June. And surprisingly, earnings were actually pretty good for the 7 tech darlings, but not enough to impress investors. The group is still doing very well for the year to date, up an average 23% for the year, and shares of Nvidia are more than double where they started. But the last 2 months have been brutal, with Nvidia alone down 23%, Alphabet falling 18%, and we won't even talk about Tesla for fear of triggering some kind of PTSD in investors. Is the hottest stock trend of the last 2 years fading? And more importantly, should you even be following these hot trends like the Magnificent 7 or avoid that crowd mentality? I'm going to reveal the data behind the market's biggest trends and how to invest, along with the important updates to shares of MPW and Netflix. But first, do not invest another penny in options until you check out the relaunch of my Ultimate Options course for all 29 option strategies. Over 3 hours of video, I start with the basics, then walk you through each option strategy, when to use it, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. Right now, I'm relaunching the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 relaunch discount is only available with the coupon code in the description below, so click through there and look for that, or scan the QR code here. Back to our main topic, and is the Magnificent 7 dead as an investing theme? Of course, long-term, these companies like Nvidia, Apple, Amazon, Meta Platforms, Microsoft are going to do great as companies, but the group has underperformed the equal-weighted S&P 500 by more than 18% since mid-July. Investors couldn't get to the exits fast enough last week. Since the Magnificent 7 trend was first mentioned in June 2023, the 7 tech giants are up an average 48%, with Meta up 83%, and Nvidia surging 160% over that period. But as an investor, can you continue to buy shares of the entire group and not really have to worry about the individual company performance? I'm not just talking about the Magnificent 7 here trend, but how long should investors follow these trending stocks before avoiding that herd mentality? For that, Derek Horstmeyer, professor of finance at George Mason University, put some research together for the Wall Street Journal that's instructive and I think can help you avoid losses when some of these bubble trends pop. Horstmeyer studied the rise and fall of 8 popular stock trends, and we can see them here. Some of them you might not be as familiar with. Some of them are kind of redundant, some kind of overlapping. But we've got FANG, the first one, the Facebook, Amazon, Netflix, and Google, followed by WATCH, the WATCH, that was Walmart, Amazon, Target, Costco, Home Depot. Then we have the FANG with 2 A's, which was Facebook, Amazon, Apple, Netflix, and Google. We have granola, which was mostly a European stock trend. We have the GSK, Roche, Nestlé's, L'Oreal, LVMH, Novartis, Novo Nordisk, ASML, AstraZeneca, SAP, and Sanofi in that one. Then the MTSAAS, that's more of a software as a service trend with Microsoft, Twilio, Salesforce, Adobe, Amazon, Shopify, BAT, which was the Chinese internet theme that went on for a little while. That was Baidu, Alibaba, and Tencent. And then cloud, the PayPal, Zoom, Vimeo, Dropbox, Alphabet, and Adobe. So we see in some of these, it wasn't necessarily an acronym where it's spelled out like FANG, the Facebook, Amazon, Netflix, and Google, but just a broader trend of group of stocks that were similar, like WATCH, which was Alphabet, Amazon, Target, Costco, Home Depot, clearly those consumer retail names, or the cloud names, or the software as a service names. He researched the first mention of these stocks as a hot developing trend and then studied price returns in the 24 preceding and following months. So he looked for in the public media when these trends or when these named trends really first appeared. Obviously, Facebook, Amazon, Netflix, and Google have been around for many, many years, but that FANG trend really just started over here in the last few years. So what he did, he looked for the 24 preceding months, or he looked for the first public mention, and then he measured the returns 2 years before that and 2 years after that first public mention. And we can see here the returns on these were really interesting, what he found in these. Again, this is the 24 months before the public mention and 24 months after. So at 0 was when that public mention first started happening for these trending, hot trending stocks. And what you notice is, for the most part, the first thing you notice here is the price returns for each group in that stocks boomed well before the media started naming the groups. Okay, so what we have here is the negative 24 to the 0. So that's the two years before the first public mention of these stocks. And most of them did very well. You know, this software as a service, cloud, FANG, the double A FANG, some of them didn't do quite as well. The FANG, the original FANG stocks, Magnificent Seven, didn't do quite as well until the media and influencers started jumping on this bandwagon with the Magnificent Seven stocks and booming those forward. In the 24 months prior to each group becoming popular trends, though, as an average, as a whole, stocks posted a 36% annual return. Now, this is kind of intuitive when you think about it. It's that strength of returns that really gets the media and influencers' attentions talking about these stocks, looking for some kind of cute name for the group, like a FANG or Magnificent Seven. After all, who in the hell would care about WAPE, an acronym for the worst 5 stocks in the S&P 500 over the last year? But then, even for investors that were a little late to the game, the group of hot stocks here tended to do well after that first initial mention as well. So we see here the returns from 0 to 12. Okay, so those first 12 months from that first public mention averaged 13% for all 8 groups. But if you were any later than that, the risks do start to rise from the year after the stock groups became a named phenomenon. So here in these charts, at that 12 point, 12 to 24, so 1 year after the groups started becoming those hot trending stocks mentioned in the media to that 2 years post group, the groups tended to lag the S&P 500 returns by about 2% on average, so they underperformed the market. There were some outliers, of course. Investors had much longer to jump on this cloud and the BATS trends, both beating the S&P 500 by more than 60% in that full 24 months after initial mention. Some were much worse, though. Of course, this watch, granola, the MTSAAS, that software as a service one, that first chart here, just getting crushed soon after their naming. Now, the real lesson here isn't to try to time these hot stock market trends. You can make a full-time job out of keeping your ears open to these popular groups and might still not be investing right at that first public mention. The smarter investor here is going to keep their eyes open to those bigger picture trends, which sectors are rising and the industries within those sectors. Now, doing that, you're more likely to find those stock groups within the rising industries that are going to eventually become those hot named trends. Now, I do this by following the sectors first here on sectorspider.com. That's sectorspider.com. You can go here to the sector tracker tool. Gives you how the sectors are doing by return performance over the last 5 days, month, 3 months, all the way up to 5 years. Now, from there, once you think you've found the bigger picture idea, those sectors that are on the rising trend, and you want to look for the stocks and the industries within those, from there you want to investigate which industries within those trends or within those trending sectors. And you can do that here on Fidelity. The web address is absolutely ridiculous here. It's digital.fidelity.com/PRGW/digital/research/sector. I would just go to Google, search for Fidelity Sector Research. You're going to be able to find this page and go to sectors here. Now, of course, again, here you see the sector performance, that overall bigger picture performance over the month, 3 month, 1 year, 5 years. You look for those trending sectors. Again, we know that financials have done very well over the last year. I would look for more like the 3 month period, which sectors are really rising on a 3 month period against the rest of the market. Okay, so we can see here S&P financial sector has risen 7% over the last 3 months versus the broader market S&P 500 only up 1%. So so the financial sector doing very well. We want to click in there. And then from there, you can scroll down and you can see the individual industries within those. Okay, so obviously the insurance industry going to be very much different from banking industry, from capital markets industry. Just because the entire financial sector is doing really well doesn't necessarily mean that any particular stock in that sector is going to do well as well. So you want to find the industries and then the stocks within those. So you look at the financial sector here. We'll look at 3 month again. So overall up 7% for the financial sector. We do see that the financial services industry is up 8%. The insurance industry up 11%. So that is something we would want to check out. You'd want to be looking for stocks in the insurance industry as one of those rising trends over the last 3 months. Now, that's still going to take some research to find the stocks within those industries, but you're more likely to see good returns either way because that rise in performance in the overall industry is more likely to lift all the stocks in that group. Looking at some of the trends I'm seeing and the stocks I'm watching this week, first up, Netflix, ticker NFLX, is the undisputed winner in the streaming and could be getting a sentiment boost soon. The streaming provider is expected to post 15% revenue growth this year versus just 2% growth at Disney and negative 2.8% growth at Warner Bros. Discovery. The highly anticipated sequel to the Squid Game series is scheduled to premiere December 26th, and I expect the company is going to start promoting that soon. With the runaway success of the first season and subsequent bump in revenue that Netflix got from it, I think the shares could see a boost to investor sentiment and the price on that announcement and then the build up to that release. Also watching here, Walmart, ticker WMT, and Target, TGT, both seem to be consolidating share of their retail segment that could benefit them through a consumer slowdown and even beyond. Both companies beat their earnings and sales expectations to see their shares jump, while other discount peers like Dollar General, Dollar Tree, and Costco reported considerable weakness. In fact, Costco just barely beat their expectations. Now, Target is by far the cheaper stock here at 15 times on a price to earnings basis versus a cost of about 40 times price to earnings for Walmart. But the larger retailer there, Walmart, is reporting undeniable strength in the growth, which is kind of something that I look for anyway. Revenue at Walmart is expected higher 14% this year versus pretty much flat sales at Target. So we see why Target is trading so much more cheaply at just 15 times PE because it's not growing sales any. So it's having to, if it wants to grow earnings, it's having to become more efficient to grow those earnings off of flat sales. Personally, I'm fine with paying a little bit more for Walmart. Maybe not 40 times price to earnings, but a little bit more for Walmart just for that growth because I know it's going to grow into that valuation. Finally, seeing some good news for Medical Properties Trust here. MPW climbed 9.3% last week against the broader market sell-off as it appears the dissolution of tenant Steward is finally gaining some momentum. Now, the bankruptcy auction of Steward Hospitals started slow, but the company has now been approved to sell 6 hospitals in Massachusetts and to sell its physician network to a private equity firm for $245 million. MPW was forced to cut its dividend once again to protect cash flow last week, but it's still offering a 6.5% yield, and it should see operational improvement over the next year. I'm also watching UiPath, ticker PATH, which initially saw its shares jump 7% when the company reported earnings well above expectations on Thursday night, along with boosting its full-year revenue growth and announcing a $500 million stock buyback program. Unfortunately, it wasn't enough to escape the black hole that was Friday's stock market, and shares closed down 6% on the day. Now, while broader market sentiment is could take these shares down further, so if investors just keep on selling stocks in general, it's going to send UiPath down as well. But I'm taking the opportunity to pick up more shares of Path here. The initial share reaction shows that investors are very happy with the company's growth and its direction forward, which should take the stock higher when the rest of the market calms down a little bit. Advanced Auto Parts, ticker AAP, has seen its shares plunge 35% just since the mid-August earnings release on another miss in earnings and lower guidance, but I'm picking up more shares of this incredibly cheap stock. I originally started buying last November at around $50 a share on the idea that it's going to attract that activist investor or even private equity buyers. The company did settle with activist Dan Loeb in March to add 3 members to the board, so it did attract that activist investor interest, and recently announced its sale of WorldPac, a WorldPac segment, for $1.5 billion. That's going to go to pay down some of that debt. While growth is nothing to get excited about, in fact, it's expected flat over the next couple of years, a climbing age of vehicles on the road is just going to help support industry sales in general, and that debt paydown helps to lower the company's enterprise value to revenue to just 0.4 times, which is extremely low. I mean, this is one of the metrics that you look for in private equity for trying to find companies to buy in venture capital, where I used to work. The share price is at a 14-year low, and the company still has some valuable assets that could attract a buyer. Also picking up shares of Zscaler, ticker ZS. It's become the cheapest cybersecurity stock I follow after a 17% dive post-earnings last week. Now, even on that disappointing outlook given by management, though, revenue is still expected up 20% this year to $2.6 billion. On a market cap of $24 billion, that's under 10 times price to sales, and just 0.47 times on a growth-adjusted valuation, right? So if you do price to sales about 10 times, sales growth of 20% or 20, so you do the 10 divided by 20, just 0.47 on a growth-adjusted valuation basis. And I used the sell-off as an opportunity to double my position, adding another 150 shares in this long-term holding. Looking back at that bigger picture and the sectors in the market with the SectorSpider.com sector tracker, just 2 of the 11 stock sectors did close higher last week, with these consumer staples and utilities really fulfilling their relative safe haven roles for stocks, and then real estate once again benefiting from the hope for lower interest rates that are going to support those property prices. Real estate stocks have now rebounded 14% in the last 3 months and are the 4th best sector after communication services, utilities, and financials in the market. The 5-year return of 9.6% on REITs is still the worst among 11 sectors, though, hinting that there could be more upside still available for these property stocks as the interest rate environment changes. Looking at other trends and valuations here in the market, technology and energy stocks have been the big laggards over the last 3 months on that market volatility and really the change in stocks. Energy stocks have fallen on fears of weaker demand for oil, while record U.S. production keeps those supplies high. Oil prices could fall further here, but should have considerable support between $60 to $65 per barrel. So that's where I would start picking up oil stocks, right around $60 to $65 per barrel of oil. They are still very strongly cash flow positive, and I don't think oil is going to fall too much more without just a catastrophic recession. Technology stocks are still relatively expensive, though, at 27.3 times on a forward basis. So that's the price of the stocks in that sector divided by the earnings expected over the next year versus a 10-year average PE at just 20.8 times. So even as much as technology stocks have fallen over the last couple of weeks, they're still relatively expensive on that PE basis. That means unless investor sentiment on the economy turns, stocks in this sector are likely to see more weakness. Now, we do see relatively cheaper sectors remaining in utilities, real estate, energy, and consumer discretionary. Get that $150 discount and everything you need to make money with options investing with the coupon code in the link below. I'll guide you through all 29 option strategies, give you the strategy finder and the options calculator so you know exactly how much you'll make. That relaunch discount is only good for the next 4 days, so don't wait. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.